We are back. Thank you everyone for being here for our Q4 interest rate webinar, which is crazy that it's Q4. For those of you who recognize my voice, my name is Sarah Conklin, co-host of the Rate Guy podcast, and as JP loves to say, the real boss here at Pensford. Now, before we get started, a few housekeeping notes. Presentation slides will be sent out after the webinar, so be on the lookout for those, and we'll do a brief Q&A at the very end with JP, so send your questions in the chat, and I'll be sure to send a few of those his way. And now, without further ado, here's the man who's as sure about Georgia deserving a spot in the college playoffs as he is about interest rates, JP Conklin.
All right. Thanks for having me, everybody. Thanks for joining. Nothing better than sitting around talking about interest rates for an hour. So we'll try to make this as much fun as possible. Sarah always makes me do the commercial at the beginning. Usually I make an Amazon joke here, but right before I walked into the room, I pointed out that her wristwatch was ticking so loudly I could hear it. And she said, is it ticking that I'm not a Rolex, I'm not a Rolex, I'm not a Rolex? So she's now off screen, probably a touch embarrassed by that comment. But just for newcomers, Pensford is an interest rate advisory firm, and we make strategic input a huge part of our business. And so there are plenty of cap providers out there. We're all going to end up going to the same banks. They're largely dictated by the lenders. We spend a lot of time in between transactions trying to provide analysis and make recommendations. The other thing that we started doing this year, because we realized there was a lot of people paying for this, was providing free mark-to-markets. So if you have a portfolio and you want to have free mark-to-markets, just let us know. It's something that we provide free of cost to our customers. LoanBoss is the software company I started about 4 years ago, and essentially tries to automate all aspects of the debt financing. So we take all of the loan documents, all the provisions, we incorporate all of that with live cash flows and live interest rates, automate all of that into one seamless platform, so you don't have to keep updating spreadsheets or running to the Pensford website for the forward curve. So as you'll see at the bottom, we stress this every time, is that across both companies, we are very relationship centric. So we know that this is a relationship business. I've been doing this for 20 years, have been fortunate enough to become really good friends with a lot of our customers, and enjoy doing stuff like this. So with that, let's sort of jump in. Want to give a big shout out to the people who commit energy into giving their very educated interest rate thoughts. Everybody on here is far more qualified than me, so I would encourage you to go check them out. A lot of good information here, and a lot of the stuff that you're going to see today is some form of what these people have put forward. So many thanks to this group. Before we talk about the markets, maybe we'll give a quick overview of the things that we're seeing from like a creative standpoint. We're seeing, just especially with the drop in the last 30 days, a lot of people buying forward starting hedges. Let's say you have an agency hedge and you're going to be buying a 1-year cap a year out. Locking in the dip in the forward curve also helps you save money and reset the escrow calcs. The floors we've been talking about all year, now that the market has started to say, hey, the Fed's going to be cutting, those have gotten a lot more expensive. So you may not have missed the boat entirely, but for the people who did buy floors who think maybe it's overdone, we're seeing some unwinds there too, taking that money off the table. A lot of people don't know this, but we spend a lot of time negotiating swaps. Sometimes you'll hear like, well, I'm just swapping with my lender. That's how they all are. That's not unique. That doesn't preclude us from helping negotiate the terms of that swap. We don't try to direct it away from the lender. We just try to make sure that you have full transparency around that. And as far as the analysis goes, what you'll see is in this example, because volatility is so high, caps are pretty inefficient, and we're seeing clients switch to swaps if they have a balance sheet lender, and then putting money to buy it down to whatever the strike would be if it was a cap, because you're still going to come out of pocket less than if you had put that money towards something with volatility. And then last but not least is just cash is king. If you want to offer up cash and say, can you raise my strike, or can you make it go away? Can I just escrow for this? And you take it out of there. I don't want to pay for the inefficiency of a cap in a high volatility market. Is there a way that we can negotiate that? So we've seen that a lot lately with the debt funds. I know we brought this up last time. Just be mindful. The list of hedge providers has changed dramatically in the last 2 years. As you can see, SMBC a couple years ago 93% of the caps that we worked on. Today, that's 20%. And it's not a knock on SMBC. They're still a great shop and they provide really aggressive pricing. It's really a reflection that other banks like Wells and US Bank have really got into this business aggressively. And so we've seen a much better diversification of hedge providers. What to expect at next week's FOMC meeting. I think it's a foregone conclusion that they're not hiking. For those of you that don't go to the CME FedWatch website, I would encourage it. It gives you futures odds of those hikes. And anytime there's a disagreement between the market and the Fed looks at that and says, hey, if we disagree, we need to push those odds up north of 60%. And so kind of back in the envelope, once the odds exceed 60% of a decision, and the Fed is not countering that publicly, it means that's what's happening. So if you went and looked right now, I bet the CME website would say that there's like a 0.01% probability of a hike next week. They're not hiking. And by most estimations, they're done. What's interesting is 2 meetings ago, because they released the summary of the economic projections, that's the dots, the SEPs, 2 meetings ago in September, they said they were still going to hike one more time this year. We're obviously not hiking one more time. But that's not it. They're going to update the summary of economic projections. Inflation is already below what they thought it was going to be in just September. Unemployment is already above what they thought it was going to be in September. And I think they're still going to talk about higher for longer, and we pinky swear promise we mean it. Please don't start pricing in cuts. It's counterproductive to what we're trying to accomplish here. I'm not sure that the market's going to buy it, but I think they're going to keep rattling that saber for as long as they can. And as you'll see here, that Fed speak has gotten back to basically neutral. It's been hawkish all year, going on 18 months. It's back to neutral. The next step is dovish. They'll hold off as long as possible because it's counterproductive. But as you can see across the globe, more central banks are now cutting rates than hiking rates. If you go back a year, it was like 99% of all central banks were hiking instead of cutting. Financial conditions, when Powell talks about financial conditions, this is the graph he's referencing. I made a joke here because the Eagles got spanked by the Niners Sunday. It was pretty brutal to watch. Financial conditions are sufficiently restrictive. And what he's talking about is crossing this threshold, this gray dashed line. And this is the Fed applying the brakes to the economy. Anything down here is accommodative. And so 18 months ago, I sort of missed the boat on the Fed hiking. And one of the things a Fed economist told me was, JP, we view that we're not applying the brakes this entire time as we ride this curve higher. We don't start applying the brakes until we're here. Well, guess what? We're there now. We've been there for a year now. The Fed does believe it's applying the brakes, and you keep hearing Powell saying sufficiently restrictive, meaning we're going to leave them here. He's not saying, well, there's more work to do, we need to keep hiking. Those are off the table. He believes he can just leave it here, and it will be restrictive, and it will continue to slow us down without needing to hike anymore. What they need more than anything else is just time. 10-year Treasury is going on quite a wild ride. Not that much longer than a month ago, it had peaked at 5%. Since then, University of Michigan's filmed a lot of opponents, helped them win some games. And in that time, 10 years fallen back to 410. I think right before we hopped on, it was like 415, 416. It's one of the biggest 30-day moves that we've had in the last 20 years. So you can see we're seeing a ton of volatility in the 10-year Treasury. I don't know that that's going to continue. I think that the market is sort of shaking that out. We might see it settle down. But I think overall volatility has not yet been sucked out of the market. Crazy topic. We keep hearing about China selling treasuries. You're reading that in the Wall Street Journal. Keep in mind, China has spent the last 10 years getting really good at concealing their purchases of treasuries. And so this is taken straight from this foreign affairs think tank that a gentleman named Brad Setzer works at. And his stuff is incredibly helpful for thinking through this. And he pointed out really 2 simplistic things. Number one is China's holdings, when you account for all the different ways that they're trying to hide the holdings, is largely constant. That's like this green line right here. So they've largely kept it constant for the last 10 years. It's not what you're reading in the headlines. That's a very formal, official U.S. government statistics table. Because in 2012, after the financial crisis, the U.S. said, hey, we've got to peel back the veil on this stuff and make sure we have full transparency into who owns this. That immediately sprung up a cottage industry in Europe where these countries now allow central banks to conceal their purchases through these custodian accounts. So we highlighted Belgium, Luxembourg, and Ireland. This is the amount of treasury holdings these countries have have started to hold since, sort of 2012-ish. Sort of like Luxembourg's this dark blue line, like that is somewhere in the magnitude of 100 times Luxembourg's GDP is being housed as U.S. Treasuries there. So don't buy the hype about the official government statistics. China's just shifting it around and trying to conceal the way where they're buying it. They're not going to sell treasuries en masse. And I get to ask this question every speaking engagement I go to about China selling. And the first thing I say is, just remember, the Fed could easily offset whatever China does by jumping in and being a buyer, right? And so right now in the official holdings, China has about 800 billion in treasuries. The last round of quantitative easing that the U.S. underwent, we bought 80 billion per month of treasuries. So in 10 months, we could completely buy up every treasury that China sells, right? China knows this, and they're like, it's a fool's errand. It's not worth pursuing, so they just don't even try it. So I think this has been one of those boogeymen that's been in headlines for my entire career. It's just totally overstated. What is interesting, however, is how expensive funding the deficit is getting, particularly as previous Treasury issuances are starting to roll over. So the thing that I'll highlight here is, you can see the Fed funds line. That's what is this blue line, basically replicating what interest rates are doing. Focus on this bottom area, this light gray area. This is T-bills, which are by definition 1 year and less in maturity. So you can see the composition is spread out at all times. Like they have controllers, and they're just trying to decide what is the best way to issue these treasuries. Go back a couple years, you can see rates start climbing. They say, you know what, we're gonna bump up some of the short-term issuance, but by and large, they were still issuing sort of that 2 to 10 year fixed rate bonds right there. Come back, rates bottom out. Guess what? They ramp it up. There is no short-term issuance at this point. They basically say we're not going to miss this window. Let's lock in some long-term stuff at attractive rates. Not that different than consumers locking in mortgages. Look how much 1 year and less paper has surged this year. The Treasury is doing the exact same thing most of the clients are doing, which is saying, you know what, this feels a little bit like a top. Let's go ahead, issue something for 1 year, ride out the storm, and on the other side of this, have flexibility to do something different. This tells me Treasury and Powell are having a discussion saying, hey, how long are we going to be up there? Should we be doing 1 year and less? Are we okay if we do that? And I suspect that Powell and Yellen are having conversations saying, you know what, weather the storm a year from now, you'll be reissuing this debt at much lower levels. Don't lock in for 10 years right now because there's going to be a backside to this curve. Lots of talk for higher for longer. So, I look at University of Texas alum Matthew McConaughey and say, you know what, 10-year Treasury is behaving a lot like him, higher for longer. In this example, you can see the 10-year is misbehaving relative to every other cycle after the last hike. Generally speaking, it stays flat, and then you start to roll into a recession and it starts trending lower, and it's been higher for longer. It's misbehaving. I believe it's going to come down. It's going to correct. This that you're seeing up here is all the result of Fed speak. The Fed talking about keeping rates higher and having more hikes on the table has kept rates higher for longer. This is entirely attributable to them. Had they been silent or talking about the potential of cuts, the 10-year Treasury would already be down here. This correction is likely to continue. Here's some different forecasts of the 10-year Treasury over the next couple of years. Let's just look at sort of end of 2024. Bloomy's got it down around 322. Market says around 409. Consensus is like 390, right? So somewhere 4 or lower. In an extreme scenario, down close to 3. And two things to keep in mind is, generally speaking, the spread between Fed funds and the 10-year Treasury historically has been about 140 basis points. So if the 10-year Treasury is at 4, that's like at 260. So one of the things I would caution anybody who is looking at these fixed rates and saying, well, they're definitely going to move lower, is probably not. The fixed rates move in advance, whether Fed's about to start hiking or they're about to start cutting. Fixed rates move in advance and then wait for the floating rates to catch up. So if I was a fixed rate borrower, I'd be looking at it to saying I might want to take advantage of this, because just because the Fed starts cutting doesn't mean the 10-year is going to plunge. It tends to wait for the floating rates to catch up. And so a 4% 10-year Treasury kind of implies longer term Fed funds of 260. The reason you would see the 10-year go well below 4 is because 260 is too high. If the market says, you know what, that's too high, it's going to 150, that's when you would see 10-year treasury yields drift lower. But if we get to like 375, 390 in the next couple months, that's basically the market saying, we're done. We're going to wait until we have more information about how much the Fed's going to have to cut. Don't assume just because they start cutting that the bottom's going to fall on the 10-year treasury. It's already priced in. By now, you guys have all seen this, expectations versus reality. The spaghetti lines or the hair lines are the expectations. The solid line is actual floating rates. And so historically speaking, obviously this time could be different. The worst time to lock in a fixed rate is when fixed rates are below floating, because it means the bottom's about to fall out. Of course, this time could be different. Just keep in mind before you lock in that 10-year fixed, history would tell us you're probably going to be a little bit frustrated at some point. Most of the clients that we talk to seem to be gravitating towards 5-year fixed if they're doing fixed, because it still lowers the rate. They pay up for some prepayment flexibility, but it's still better than floating when you, especially if you factor in a cap. That all makes total sense to me. This is purely from an interest rate standpoint, not a recommendation on what you guys should do. So are we going to have cuts in 2024? The market's already saying yes, we're going to see substantial cuts. Fed funds forward curve is below 4%. I think it's around 388 this morning. And so the market is saying they're cutting pretty dramatically next year. Conversely, the Fed is saying, nah, 5.125, one cut, essentially. That's what the Fed is predicting. And so if you look out over here, we've got a couple different scenarios playing out. The hard landing scenario, which I don't think is going to happen given the fact that there has been so much runway with all the post-pandemic stimulus, that I just don't see this happening barring something incredibly dramatic happening. The SEP, this is the Fed, this is their summary of economic projections. They're, of course, projecting a nice linear disciplined descent down, but keep in mind, the Fed themselves are not saying rates are staying here forever. And so I'll tend to read stuff online about, hey, this is the new normal. Like, that's not the case. The Fed is not saying that. That is somebody's takeaway. The Fed is saying we will be cutting rates heading back sub 4% in the next couple of years. That this is applying the brakes. We know we're going to have to take our foot off the brakes at some time. Market's around 380. I'm sort of in that like 412-ish camp, somewhere between 4 and 4.25. And then the soft landing would be the scenario where they say, you know what, let's very quickly, so this would happen probably Q1, very quickly back out 50, 75 basis points. We've applied a lot of brakes. Let's take some off and just see what happens. That's where you would see this occur. I don't think that's going to happen. I think they're probably going to wait too long, but we'll talk about that. And then I promise this will be the last Matthew McConaughey reference. I don't think you guys will ever appreciate how close you came to having an entire webinar dedicated to Matthew McConaughey memes, because there are just so many of them. But I'll note here, just to troll my Longhorn friends, this is him celebrating, looking at the Big 12 competition level, knowing he doesn't have to play Oklahoma from the 1980s, and knowing that the committee wants Texas to make the playoffs before they join a real conference. Turns out the Fed isn't any better at this than we are, right? That their expectations are wrong all the time. And so let's be mindful of that as we see this meeting next week and they start projecting what's going to happen next year. They're going to be wrong. They will 100% be wrong. And generally speaking, they are the wrong the most during a cutting cycle. So we went back and looked and just said, okay, based on what they were projecting out over the sort of 3, 6, 9, 12 months and after, how wrong were they, right? And so let's start with this top line. Overall, on average, across all cycles, they're not that bad. Like, they're pretty much spot on. So they get really far out, but that's unrealistic, but pretty good for the next year or so, right? And then during hikes, they're not that much worse. They're off by a little bit, but 1 to 2 hikes, it's nothing that dramatic. Probably influenced somewhat by this last cycle. But look at what happens when they start cutting. They're off, and they're off by a pretty large margin. When you stretch it out a year, they're off by 1.5 points. And so the last summary of economic projections we had was September, and they were saying 5.125 at the end of next year. And so if they're wrong by the same amount, that would put Fed funds at 358 at the end of next year. It sounds impossible as we sit here today. It sounds like there's no way that's going to happen. History would tell us this is how it always happens. They're always behind the curve. They're not good at knowing when they're going to have to pivot, and it always sneaks up on them, and they're generally behind the curve when they have to. Now, market bets on cuts expressed via, being long SOFR, they've surged faster than a Dallas Cowboys fan's belief that this is actually going to be their year. And so you can see these contracts have spiked dramatically. The market is rolling over saying this is heading lower. We need to start making these preparations. So I see sort of three main outcomes next year. I'll sort of talk about the probability of each. The first one is kind of like a single cut on the far side of the election, right? There's going to be an optics problem for the Fed sometime around next summer when they start to get commingled with a presidential election. And I think the only way they can do that is they move before it, they set it on autopilot, or they move after. And so this scenario is sort of the first one, move after. And this is for all the people out there who are confident inflation is repeating the 70s and 80s. This is the scenario for you guys. Let's just wait till we're on the far side. Let's really drive a stake through the heart of inflation and be done with this thing. And if we cut, it'll be on the far side of the election so as not to be perceived as trying to influence it. The second scenario is kind of what normally happens. So this is kind of like the base case scenario, which is they wait too long. They can't care about the optics anymore because the wheels are falling off, right? And so then they just start slashing and burning. We might finish the year in the high fours, but it's obviously in a death spiral towards 3 or below 3, 250. Like they're cutting really aggressively at this point. And then the last one, maybe the one I'm most hopeful for, is sort of like this idea of pegging Fed funds to inflation, because they view Fed funds above inflation. So Fed funds is sort of, let's say, 5.5. Inflation core PC is 3.5. That's applying the brakes. And as long as they keep applying the brakes, they can drift lower with that, right? And so it's almost like we're just solving whatever inflation is going to be. We're going to add 1.5 to 2% on top of that. And so I refer to this as like the braking action. What I've not put out in any of my newsletters is in the last two webinars, a unique phrase that I had put in there, different phrases in each one, a couple weeks later popped into a Wall Street Journal headline. And so I'll be interested to see if this phrase, because I haven't seen other people use it, braking action, magically pops into a Wall Street Journal article in the weeks ahead. If not, then maybe that person is actually on right now. If it does, it means they're probably getting forwarded the material and not listening to me talk about them behind their back. I won't call out their names, but I'll be interested to see if this shows up there. But the idea here is, let's just set Fed funds some amount above core inflation. That's it, right? And if it goes down, we'll go down with it, because then we're still applying the exact same amount of braking action. I think people are misconstruing higher for longer as just at 5% forever. And that's not really what they're after. What they're after is we want to keep applying the brakes to the economy. If inflation comes down, they can maintain the exact same amount of braking pressure on the economy even as they're cutting interest rates. This is a really important concept for next year. I'm hopeful that they'll do this. I think that there's a chance that Powell is going to do something along these lines. Probably won't be as blatant as just targeting it like this. But don't be surprised if the Fed is saying, hey, we think inflation is going to be at, the last projection said 2.6 at the end of next year. Add 2% to that, 4.6, right? So even in that base scenario, the Fed is cutting almost a point next year. There's also a chance that 2% is too high. Powell keeps saying that we are in very restrictive levels. There's a chance that he may say 2's too high. We actually need to let off the brakes a touch, drift down to 150 over that. Now you're talking about 410, right? In these scenarios, very realistic scenarios that the Fed has outlined themselves, the Fed is cutting next year. For people who are saying the Fed is not cutting, the only argument for the Fed not cutting next year is inflation reaccelerates. It will not be because it's not moving lower fast enough. They're applying the brakes. They don't want to make it worse. It's clearly working. Let's just keep drifting down with it. Here are two other measures. This is a market index, 1 year forward, 1.9, add 2, 3.9 Fed funds, right? And then Cleveland has this really cool inflation nowcast, 2.8, add 2, you're at 4.8, right? In all of these scenarios, the Fed is cutting at least 3 times next year and likely more. And so it suddenly dawned on me, Powell's been talking about rates higher for longer. We all sort of woke up a couple of months ago and everybody started believing in higher for longer. People are still talking about higher for longer in 2024. And I realized, holy cow, they've done such a good job of convincing us rates are going to be higher for longer in 2024. We barely noticed. They haven't hiked in 5 months. The only time the Fed has ever paused for at least 6 months and then started hiking again was the 1960s. There is almost no precedent for this. It's like they pulled the wool over our eyes. They did a great job of messaging. They've crushed it. We all fell for it. And now I'm wondering, okay, well, what happens when the market stops buying what Powell is saying? And I think that is exactly what has happened over the last 30 days. That we have some of the biggest drops on record, because it's like everybody woke up a few months ago, said higher for longer. Everybody woke up a few months later, said, wait a minute, they haven't hiked since July. They're not hiking again. And rates tanked. So you see the 10-year treasuries down 70 basis points, the 2-year treasuries down 70 basis points. Huge moves in 30 days as the market just sort of woke up to this realization that the Fed is done and the Fed is cutting next year. That has helped cap prices. Caps are down about 25% off their peak in the last 30 days. Now, that depends on sort of the term and the structure. 1 years won't benefit quite as much because you got to really start getting the cuts priced in aggressively before the 1 year will benefit that much. 2 and 3 years have absolutely dropped pretty considerably. We've looked at structures that are down 40% in the last 30 days. So if you looked at a cap a month or two ago and you haven't looked at it recently, you should get an update on that. Higher for longer kept cap prices higher for longer too, right? We've been showing this graph for over a year now. Is like we just needed to make it to the pause. And once we got to the pause, cap prices would roll over. They'd come back down pretty dramatically, 50% in 3 months, right? And they didn't. And what I realized was it's because it wasn't when they actually paused. It's when the market realized they were done. And all that Fed speak about higher for longer worked so well, it kept everything elevated until all of a sudden we all realized, nope, it's coming back down. And now it's starting to roll over. So we're down 25%. You're probably going to see cap prices keep coming down unless they see inflation data reaccelerating. We're obviously going to spend a little bit of time talking about inflation because some people have no shame about being wrong. Jim Harbaugh liked to say that Michigan is America's team. Cowboys think they're America's team. Obviously, neither are correct. Some guy named JP Conklin said that there would be no Fed hikes in 2022. And unfortunately, I said that very late in 2021. It wasn't even like a year out. It was just a couple months out. Thank you, Warren, for reminding me of that this year. But here's the thing. Inflation is not going to reaccelerate. Money supply has fallen off a cliff, an absolute cliff this year, unprecedented contraction in money supply. It is going to work its way through the system. This is a global phenomenon. This is not unique to the United States. Everywhere except for Japan is falling off of a cliff. China's negative. All the other ones are down dramatically. Japan's like finally at the level that they wanted to be at for 30 years. And they're like, oh, wait a minute. Now everybody's complaining. We finally got up to 2% and everybody wants us to start cutting again. This is a global phenomenon. We have worked our way through the COVID shocks. This is from an SMBC research piece. SMBC's research team puts out some amazing stuff. So if you're buying caps from them and you want to get on their list, they'll add you to it. It's great stuff. But what they noted was that the producer price index usually is highly correlated with the 10-year break-even rate. And the 10-year break-even rate is really what the market thinks inflation is going to average for the next 10 years. So right now we're up around 2.4%, right? But that has detached from producer price index. Producer price index, this is a left axis number over here, peaked at 18% in June 2022. I don't understand how people can say we haven't made progress on inflation when the PPI was at 18% in June and 18 months later, it's negative. How can you argue we haven't made progress on inflation? So if this relationship were to correct, the 10-year break-even rate, essentially what the market thinks inflation is going to average, should drop down to about 1.7. Right? Again, we're now in the 2% range and, with some margin for error, like that's back where it's supposed to be. Like we're on this trajectory already. Rents, we all know by now, rents make up a huge chunk of the overall inflation picture, but the government data is stale. That's this light blue line. So you can see this light blue line for just the rents from the government stats is trailing. It's really stale. It's starting to roll over. We're seeing it come back down, but you keep reading the headlines. Well, it's still elevated. It's still elevated. Well, yeah, but it's elevated because it's so old. It's not because it's persistent. If you use something else that actually tries to account for those lags, it's already fallen off a cliff. And so like my favorite one is the Penn State one. I'm a Penn State homer. It actually went negative and rebounded, and we're actually coming out of it. So we've actually seen the bottom behind us and starting to come out of it. The government stats won't reflect that for a year. It won't feel like we're bottoming out for like a year. It is so stale. Fortunately, the Fed has its own index, and it too has fallen off a cliff, right? And so to me, this light blue line that you're seeing for the government stats, this is not a forecast that this is going to keep coming down. This is just a mathematical equation. This is coming down, and because it makes up such a huge chunk of core PCE at 3.5 is absolutely going to move lower in the months ahead. It is just going to happen. It's just math. This is not an economic forecast anymore. Here's what that looks like. So you've got CPI. Again, people who say we haven't made enough progress. I'm like, well, we were at 9.1 18 months ago, and now we're in the low threes. It feels like we've made some pretty good progress. Core PCE, not where we want it to be at 2, but clearly on the path. And the way that economists look at core PCE, if you're trying to be more current than just the annual numbers, because we're picking up stuff from a year ago, it's pretty stale. They'll say, give me the last 3 months and annualize that number. And if you do that with core PCE, it's already at 2.4, right? Like this has already happened. They're already well on their way to 2%. And we're now entering territory where we're going to overshoot and overcorrect and cause more pain than we otherwise need to. The light blue one, again, the Penn State index I like so much. If you didn't hear when I first started highlighting this one, I came across it because my brother was, his advisor was Dr. Ambrose at Penn State, and he came out with this index in 2016 because he believed inflation was understated. Look at right here. So here's CPI, and he's like, I don't think this is accurate. I think the government stats are so stale as to be messing with the numbers. This is when he came out with it. None of it's paid any attention to it, right? It eventually caught back up. Now all of a sudden it's on the other side and saying inflation is not 3.5%. Inflation is core inflation. So this is the inflation that the Fed cares about is sub 2%. I think the last one came out at 1.7. We still have 2 camps of inflation. Camp 1 is the old guard, right? This is the camp that says, I don't want to repeat the 70s and 80s. I think that Powell does not fall into this camp, but he is mindful of this camp, where he's saying, listen, we've already had these 2 mountains, and I don't want to leave Everest hanging out there, right? I don't want to saddle my successor with what Volcker had to deal with because we let off the brakes too soon. So this camp says, keep it up, no cuts next year. Let's really drive this thing to the ground, which is a fair assessment. I just don't think it's accurate. The second one is post-World War II. And so this graph was in the last one, and because it was far and away the most requested graph, I included it again. I think COVID is a lot like World War II. There is a huge burst of federal spending, and couple that with a huge restriction on labor supply, you have a sudden surge of inflation. We have worked our way through this. Post-World War II, inflation actually went negative. We had deflation a few years after. I think we are underestimating the risk of us driving this down to 0%. Generally speaking, following a recession, inflation falls by about 50%, okay? And what I think is maybe not being talked about right now enough is we have made all of this progress. PPI was 18%, and it's now 0. CPI was 9.1. It's now 3. Core PCE has dropped from the 6s to 3.5. All that progress has been made without a recession. What happens if we have one, right? I'm a little worried that the bottom's going to fall out. But even if it doesn't, and inflation, we have a recession, it's not nasty, it's just a normal recession, and inflation falls by half, you take core PC at 3.5, you cut it in half, 1.75, like we're sub 2. Like we're well on our way. This is happening in the next year to 18 months. And hopefully we don't have either the Volcker or the financial crisis. But just be mindful, like all this progress has come without a ton of economic pain. What happens if we do have economic pain? How much could it fall? And what's interesting to know, we all have seen the hairy graph when it comes to interest rates and expectations. Well, the same thing happens with inflation and inflation expectations. We're always wrong. And look how volatile inflation is. There is never a time where inflation just hangs out at a certain level and just stays there for an extended period of time. But note how all of expectations start leveling off at 2%. It doesn't matter if we're going up or coming down. We all just always think it's going to be around 2%. And what happens is we're wrong. And when inflation is going up, we underestimate how high it's going to go. When it's coming down, we underestimate how low it's going to go. I think we're positioning ourselves for the exact same thing. We all think it's going to level off nice and easy right here, and I'm not sure that that's going to happen. And so what we've heard a lot of is there's this like sticking point where inflation is going to sort of stop at 3%. It's that last mile that's going to be the hardest. And I don't think that that's really going to happen. But one of the questions we get a lot is what happens if the Fed changes the target? Should the target be changed from, let's say, 2 to 3%? And the answer is no. I think there's almost a 0% probability that the Fed will change the target just because they can't get to the target. Their number one tool is credibility. They'll lose all credibility, and they won't do that. What they will instead do is start changing their tune, and they'll start saying, you know what, rates are sufficiently restrictive, things are cooling, it's just going to take a while. They'll start talking about time more so than anything else, because here's the thing. What if Powell has to sacrifice 1.5 million jobs just to get inflation from 3 to 2, right? So that would be unemployment going from 4 to 5, right? About 1.5 million Americans have to lose their job for each 1% of unemployment increase, right? I don't think he's going to do that, because it's easy to talk tough when the unemployment rate is 4%, less so when it's at 5 and climbing, right? Everybody's a tough guy when unemployment's at all-time lows. I'm not sure after 1.5 million Americans lose their jobs that he'll be talking that way, particularly in an election year. So even if I'm wrong and inflation is sticky at 3, I still think the Fed will say, you know what, it's not worth the economic damage to get to this arbitrary number. Where did that arbitrary number come from? It turns out it comes from central banker in New Zealand. So before we jump into that, thought, you know what, I've never looked up New Zealand before. It's got some interesting stats. Let's find some stuff out. It's roughly the size of the population of Colorado. They have more sheep than humans. This was an odd one. Tom Brady's never dropped a Super Bowl pass there. That was interesting. It's the filming location of the Lord of the Rings. It has the same GDP as Alabama, but 16 fewer national championships. Generally not recognized as a bastion for economic theory. But it is the birthplace of the 2% inflation target, and that's because in 1989, New Zealand central banker Don Brash made this off-the-cuff remark about 2%. They formalized it a little bit later, and it got locked in. And he was interviewed earlier this year. He's like, it caught on like wildfire. I have no idea where that came from. And everybody just sort of adopted it, and we've all forgotten where did it come from, right? So there's really no great reason to use 2 instead of 3 or instead of 1. In fact, Greenspan preferred 0 to 1% at the time, and that's why we were slow to adopt it, because Greenspan thought it was the wrong number. The CPI contributions really are still coming from servicing, which is this yellow bar, right? That's not that different. Like, that hasn't changed from 2019 pre-COVID stuff. What has changed is all the other things have fallen off a cliff, right? And now we're really just left with services. And this is what is keeping things elevated. When I think of services, we've got them listed out here. I generally think of jobs, right? That is what is keeping services elevated. Obviously, with 100% confidence, Jim Harbaugh has cheated. And the Ryan Day out of Ohio State will love to hear that one job in Michigan has been lost when Harbaugh moves on to the Chicago Bears head coaching job. But Jim Harbaugh is also shows up in the Jolt stats, because I don't trust these stats one bit. These numbers have a response rate during a survey of 31%. People are not responding to this, and yet we're still treating it as if it's the Bible. Even if you do believe it, it missed. It came in 800,000 jobs lower this week than last month. 800,000 job listings disappeared over the course of the last 30 days. Like, this is starting to happen. SMBC also has this really great unemployment momentum index, which is essentially today's unemployment rate minus the 2-year average, right? So a positive number means we're going the wrong way. We're moving into recession territory. We are in positive territory right now, and we're on the verge of probably having a recession. I won't be good at predicting how deep it'll be. But what's interesting to note is, generally speaking, the Fed doesn't wait that long to start cutting interest rates once inflation has moved much, right? They don't want to see a lot of people lose their jobs. Now, this is the problem that they had in the 70s and 80s. Once unemployment started surging, they backed off. And so I think Powell's going to be mindful of that. I do think this time's a little bit different. But generally speaking, Fed presidents don't want to see a lot of Americans lose their jobs just to try to win some artificial inflation target battle. This brings us to the SOM rule. If you've been following our newsletter, I highlight this. Dr. Claudia Somm, University of Michigan grad, she's got this rule that she had discovered when she was at the Fed that basically said, once we're a half a point above the 12-month low on a 3-month moving average, we always have had a recession, right? So right now, the 3-month moving average is 3.83%, right? Tomorrow, we get the next jobs report. It's supposed to come in at 3.9. If it does, then we have a 3.87 3-month moving average. That would trigger the sum. So this is what we talked about in the last webinar where Dr. Anna Wong, Bloomberg's chief economist, said, this is happening. We are underestimating the possibility of much higher unemployment. And what we keep trying to beat the drum about is this labor market is not that different than it has been in previous cycles. That is, you see here, like unemployment is just sort of bouncing along. Now we're lower than other cycles, but the lack of increase is not unique to this cycle over the first 18 months. In the first 18 months, unemployment rate generally climbs about 0.3%. It's what happens in the next 18 months that tends to be painful, 2%. So that puts unemployment rate 5.7 at some point late next year, right? FOMC said 4.1. There's a really good chance the Fed is underestimating the possibility of an unemployment rate in the fives next year. So speaking of next year, let's sort of briefly wrap up and talk about what I'm expecting. One of the questions we get a lot is about the government debt. It is definitely a big deal, and the deficit is bad, but it's not nearly as bad as James Franklin's coaching record against other top 10 teams. The thing when you read in the headlines about the absolute dollar amount, think about it in terms of percentage of GDP, because that everything's relative. And so right here you'll see it's bad. It's not catastrophic, right? And it's moving in the right direction. We probably want to get back to historical averages around 2.5%. We're still down here. We've got some work to go. The wheels have not fallen off. We're not in like uncharted waters at this point. As everybody knows, household net worth surged during COVID. And then this year, they've all fallen off a cliff. All the money is now gone. And you're seeing that at the exact same moment that student loan payments are starting back up. It's not a coincidence that credit card debt has exceeded $1 trillion for the first time ever, right? People haven't changed their spending habits. They've spent this money that they got, and when they ran out of it, they just put it on credit instead of changing their spending habits. And I think part of that is because they still feel very safe about their jobs. Once that psychology changes, once you see unemployment start moving up, the psychology changes, you're going to see a dramatic shift in consumer spending. You're already seeing delinquency start to pop up. It's nothing like out of control, 3-ish%. It's not the end of the world, but it is definitely moving higher, which is generally a canary in the coal mine for a recession as people start pulling in. The leading economic indicators, this thing without fail predicts recessions. We appear to have bottomed out, which is a good sign, but it also means GDP is probably going to hit the bottom at some point in the next 3-ish months, and unemployment is going to peak sometime late next year, right? That just because it's at 3.9 today doesn't mean it's going to be at 3.9 a year from now. It's probably going to be substantially higher. I think one of the things that's probably being under talked about for next year is quantitative tightening. To the Fed's credit, it's done a really good job of kind of taking what it can get while the getting was good. And this pace of tightening is twice what it was last time. So they're doing a good job of trying to shrink it as much as possible. Sooner or later, that's going to have an impact on market liquidity. So this is the Fed balance sheet, and then this is an index that tracks sort of treasury liquidity or illiquidity. As you can see, it is starting to pick back up, and it's starting to surge. They're meeting, and this is probably going to continue into next year. I think we just saw yesterday or 2 days ago, not a huge number in the grand scheme of things, but it was really bizarre that one of those repo markets had a seizure, and SOFR spiked 6 basis points in one day. It doesn't sound like a big thing, right? But it's a signal that there is stress in the market, right? Quantitative tightening is going to add to that stress because it's going to suck out liquidity. Now, I've seen a lot of sort of crazy hypothesis about what caused this. I don't know what it is, but it's enough to raise a red flag, right? If you zoomed out, it wouldn't be a big deal. It wouldn't look that crazy. But if you go back to 2019, you guys might remember when SOFR misbehaved by like 5% in one day. Fed had to jump in and aggressively intervene. Like this is the sort of thing that signals you might have some liquidity issues. And so that brings us back to this Fed shell game, right? SVB collapsed right here at the bottom of this line. Everybody ran to the discount window, borrowed a bunch of money just to make sure that they were okay. The Fed said within a week, they rolled out this term funding program. Everybody closed, they returned the money that they had borrowed, and instead started borrowing from this term funding program, right? And my question is, discount window is supposed to be for emergencies, right? So it behaved the way that an emergency measure would behave. This is not behaving. No one's giving back the treasuries that they put to the collateral. So my question is, if this was only for emergency measures, how come it's still out there, right? We won't know who borrowed from this until a year after it closes, which is supposed to be March of 2024. I don't think the big banks borrowed from. I think they're totally fine. I do worry about the regional banks, and I don't know what sort of stress they're under, right? But if Q1 we get notice that the Fed is extending this program instead of saying banks give us back our cash, our 120 billion in cash, something's up, right? The Fed keeps saying that it's a strong and resilient banking system. If that's true, this thing should close smoothly and everything should be fine. If it doesn't, it will raise a giant red flag. So in conclusion, next year, I'm thinking that we're going to see dramatically lower rates, particularly on floating rates, which leads to more transactions. But unfortunately, it's probably going to come at the expense of recession and job losses. And then unfortunately also for me, I live in a dumpster fire of sports fandom, and my teams are going to continue to struggle and drive me bonkers. So I will pick on other teams because I'm the one hosting the webinar, and so I'm allowed to make fun of the Longhorns if I want to. So with that, I'll sort of stop there, and I think we got about 10 minutes. See, Sarah, if you have any questions you wanted me to run through.
Hey, I do actually. And I think I'm going to start with this one because it's appropriate and timely, unlike the dig you made about my watch at the very beginning. Try to make a Jay-Z reference and it goes sideways with you. The question is, how would you compare a 5% strike cap to a 2% strike cap?
Yeah, that's a good question. We've dealt with that a lot this year. We do a lot of analysis for people, and essentially what it's boiled down to is like the 2% strike in a lot of ways feels like prepaid interest. The 5% strike might feel like maybe a waste of money, particularly if the bottom falls out. And people are like, "Hey, how should I be thinking about this?" Let me hold on 1 second. Let me see. I usually have my cap pricer up. So let's walk through an example. What was the notional amount?
50 million.
And so term?
3 years.
All right, so that's right. And then you said 5% and 2%. So I'll start with the 5%. So if you haven't seen this before, this is our cap pricer. It's on our website. We put a lot of effort into this thing. This is super accurate. It's so accurate. Sometimes brokers will forward us emails that have our competitors have copy and pasted like this grid into the email. That's how accurate it is. So if you haven't ever seen it, it is very good. But what we also try to do is not just the pricing, which you're seeing here and up here, but over here in this column, we highlight month by month, how much does each month cost? And then month by month, how much protection do I get, right? So you can see I'm not getting any protection after the first, 6-ish months. And we got this little grid down at the bottom. It says, okay, I paced 462. I'm going to receive 58. My net benefit cost is I'm really kind of throwing away $400,000. And this is largely just uncertainty, right? That's this blank column over here is uncertainty. So I would say to this customer, okay, if you buy 5%, you're probably throwing away around 400 grand, right? And I think you said the other strike was 2. So I'll change that. Notice how over here, the projected payout is much higher, right? And oh, look at this. The net cost is still about 400 grand, a little bit more. I get way more back in protection. So this is actually a great scenario because this highlights that this is a much more efficient use of money. It might be too expensive for someone to buy at 3.3 million, but in this case, about what is that 86-87% of my cap premium is going to economic benefits I'm going to get back, right? So it's highly efficient in that way. And then I think so. This says 433 is wasted. I think what was this last one? 403, right? I'm going to spend 462. I'm only getting 58 back. That's probably like 12% is on economic value. So in the last example, 87% is economic value. This example, 12% is economic value. The low strike, the 2%, is a much more efficient use of money. Now, whether or not you want to drop 3.3 million on a cap is up to you. But from an efficiency standpoint, that's where I would steer them to at least consider and think about stuff. So that's how I would guide that conversation.
Okay. Well, just so they know, you said that you got there through our website. Can you show them that, how they get there?
On the website?
Yeah.
No, I love when we ad lib on live webinars. Let's see. I usually have the website up too. Here's my Zoom. So here's the Pensford website. So up here, Cap Pricer. This is just take you to a download button where you can download this. It gets updated every day. We also have a forward curve that's pretty cool. I usually have that up too. Let me see if I have that up. Yeah, so here's our forward curve. So whenever I do a call with somebody, I always have this handy. A lot of times they'll ask for like, shocks, and I can stress all that. Plus we got all the historical data down here. And then last but not least, the podcast button. Please don't click on that because Sarah will make me keep doing the podcast. I don't want to do because it doesn't make sense to me that anybody wants to read about interest rates, let alone listen to them.
But we're thankful that you all do for the record. So we'll lead into how will the election impact rates? That's been a popular question.
Yeah. So, in the last webinar, we talked about how there's not a great correlation between which party wins and the interest rates that follow. I will say I do think it impacts psychology, and I do think it can impact transaction volume. Back in 2012, so going on over 10 years ago, Pensford was, maybe 3-ish years old at that time, and I'm having lunch with one of my favorite clients out in Raleigh named Greg with 2 Gs. And I was saying to him, it was probably like September, October. I was like, our volume has dried up completely. Like we're not doing anything at all. Is this because people think that a Democrat's going to win and it's going to be harder to do business? And he said, real estate guys make money when interest rates are 20% or 0%. Don't let them fool you on that. But all real estate professionals need to know what rules to play by. And a presidential election is a threat to those rules. It creates a lot of uncertainty around those rules. And we just need to get to the other side of the election, and I expect that you'll see sort of the transaction volume pick back up. And he was right, and it was sort of like on a tear for the next couple of years. So what I would say is I don't think it's going to have a dramatic impact one way or another on interest rates. I do think it could impact transaction volume, that even though we all believe transaction volume is going to pick up in the second half of next year, rates will be going lower. There's a ton of pent-up demand. There is this potential offsetting factor of a presidential election saying, you know what, before I sign anything, I just want to know what rules I'm going to be expected to play by. And so that sort of recovery might be on the far side of the election.
All right, I've got a layup from Charlie. Who will win the Peach Bowl? Penn State or Ole Miss?
Obviously Penn State.
Obviously.
that was a layup. I appreciate the layup.
You're welcome. Thank you, Charlie, for that one. What are the most underrated risks of 2024?
Number one is unemployment. I think Dr. Anna Wong is right. Like we are underestimating the possibility that unemployment is going to move very quickly from 4 to 5% and catch us all off guard. I think that's probably number one. Number two is probably that we were sort of talking about like quantitative tightening and that repo market graph. Financial stability. The Fed has a dual mandate of inflation and unemployment. And I believe that they have a super mandate, which is financial stability. And that whenever that gets jeopardized, they have to intervene aggressively to make sure that markets function smoothly. And I think that we've drained a lot of liquidity out in a very short amount of time. And there's some chance that we kind of, instead of have this soft landing, we just kind of run into a wall. And it all happens very quickly. And the Fed has to jump in and cut off QT. I think they'll probably have to stop QT, next summer one way or another anyway. But I think there's a chance sometime next year that the Fed has to intervene and actually provide liquidity in some form or fashion that we aren't thinking about.
This will be our last one real quick. Looking at floating versus 5-year fixed, what should this person do?
So again, like I'll just scroll down and say, okay, let's look at a 5-year swap, 375. So, you can pick up 1.75% is probably the thinking. Bank's going to tax some profit on there, so let's call it 4. So you can pick up 1.5 versus floating. And the instinct is I can save a ton of money. I should be doing a swap right now. And that might be the right answer. Keep in mind, generally speaking, the worst time to lock is when fixed rates are below floating, because it means the bottom is going to fall out. I think what I would suggest is how likely are you to be in this for the full 5 years? Right? If you're locked in at 375 to 4, are you okay with that? Plus whatever your spread is. Are you okay with that? Are you going to be mad if you miss out on a 3% floating rate or a 2.5% floating rate? Like I think back when 2007, 2008, rates were north of 5 and they fell all the way to 0, it was pretty painful. If floating rates only get down to 3.5 or 4, you didn't miss out on that much. And if you say, you know what, I can live with that, I really Just don't want the risk of the Fed not cutting the way that the market is projecting. It's kind of like our forward starting swap or forward starting cap people. Just lock this in, lock this number in. I get it totally. Maybe pay out for some sort of prepayment flexibility, but we can at least help you run through the math and the risks and considerations of each. Just like you saw on the forward curve, like we can very easily run stress scenarios. Like what if Fed funds drops to 2 versus stays elevated above 5 all year, and see how all that looks, and then just turn the business decision over to you guys.
All right. Well, we're gonna end on that. And unfortunately, Charlie is an Ole Miss fan, so I'd love to wish you good luck, Charlie. But for the sake of my household, I really hope Penn State pulls it off. The slides and the recording will be sent out, so be on the lookout for those. And any last words, JP?
Nope. Thanks for listening. Congrats on surviving another year, and look forward to a better 2024.
Have a great holiday, you guys. Bye.